Welcome to the Nadex Application and Strategy webinar series, presented by Daryl Martin from apexinvesting.com. Today we're going to talk about the 5 steps to picking a Nadex spread: market, direction, time to expiration, break-even distance, risk, and reward. Nadex spreads provide multiple trading opportunities throughout the day. And with so many trading opportunities to choose from, one of the challenges that as a trader that you're going to face is the ability to pick which one to choose. And that's why we made this video, to teach you the 5 steps to picking a Nadex spread. The first step is going to be choosing your market. When looking at what market you want to choose, you need to determine the category. Do you want to trade the indices, the commodities, or Forex? Once you've chosen what category you want to trade in, then you can easily narrow it down to what product you want to trade. So when you're looking at the indices, you can do US indices or international indices. On the US indices, you can trade the US 500, US 2000, Wall Street 30, or US Tech 100. These markets mirror the S&P 500 E-mini futures, the Russell 2000 futures, the Wall Street 30 E-minis, and the Nasdaq 100 E-mini futures. On the international indices, you have the FTSE 100, the Germany 30, and the Japan 225. The Germany 30 is the DAX, and the Japan 225 is mirroring the Nikkei. If you choose that you want to trade the commodities, you have metals, energies, and agriculturals. On the metals, you can trade gold, silver, or copper. On energies, you can trade oil or natural gas. On agricultural, you can trade corn and soybeans. If the category you chose was Forex, you have 8 different Forex pairs to choose from. You can trade the Aussie dollar, the Euro yen, the Euro dollar, the pound dollar, the pound yen, the pound dollar, US Canadian, US franc, and the US yen. What's great about this is it affords the opportunity for you to be able to trade a variety of markets all in just one account. If you're an experienced trader, you can come in and trade markets you're already familiar with. If you're a new trader, you can come in and learn new markets and do it with completely limited and defined risk, because all the products on the exchange have defined limited risk. Either way, you have the ability to focus in on 1 or 2 markets and expand out from there and try additional markets and see which ones work best for you. So on days when the euro dollar is moving, you may choose to trade that, but on other days maybe gold or the US indices or oil is moving. So you can actually transfer between different products, but you can do it very easily because the way that the Nadex spreads work is very simple to understand. With having access to a variety of markets, you can expand out to new and different markets that you may not have traded previously. And you can look at these markets and figure out which ones are moving that day, and those are the ones that you could focus in on. So you could trade the euro dollar one day, oil a different day, and then the US 500 the day after that. After you've picked your market, then you need to pick your direction. If you think the market's going to go up, you're bullish, so you'll buy the spread. If you think the market's going to go down, you're bearish, and then you'll sell the spread. And there's multiple ways to pick which direction you think the market's going to go. You could take advantage of fundamental analysis, like government news announcements. You could take advantage of technical analysis. You could look at seasonal analysis, or you could look at actually statistical analysis. After you've chosen what category, Forex, what market, say euro dollar, and a direction, say you want to sell the spread because you think the euro dollar is going to go down, now you need to choose the time to expiration. Remember, all the times listed on Nadex are Eastern time, and you want to make sure you account for that. So if it says 4 o'clock, but it is 2 o'clock your time, you want to make sure you're aware of that. So you have your shorter term expiration spreads, which could be 2 hours long, or your longer term expiration spreads that could go as long as 22 hours and 15 minutes. You may consider doing a shorter term spread, say if you're doing a scalp trade, which is you're expecting a quick, small move, or if you're doing a trade based on a scheduled government news announcement, that may be the best option for you. Maybe you're doing a trade expecting a move in a very short time frame, or on the trade that you're doing, you are wanting to pay less in time premium, and you'll get that advantage with a shorter term expiration spread. Or maybe you're doing a trade and you find that that trade provides a better opportunity for you as there's a close floor or ceiling to where the market is, and therefore it lowers your risk. You may choose a longer term expiration spread if you think there's going to be a larger move, or if you want more time to be right, so more time to have a chance to be right about your trade. If you want a trade that has more profit potential, longer term spreads are going to be wider, therefore they give you the ability to possibly increase your profit potential. Or maybe a longer term spread is going to be best for you because you can find one that is available that has a floor or ceiling that is close to where the underlying market is currently trading and provides you a low risk. The next step is really important for you to consider, and that is the break-even distance. So how far does the trade have to move before you're at break-even? Not only your bid-ask spread, but just the market getting to where the spread is currently priced. And a lot of traders make this mistake when they first start trading Nadex because they go straight to risk, because that's what we're taught to, limit our risk. And we're taught to be good risk managers as traders. But even if your risk is only $5, if it has to move 50 ticks before it's going to be break even, it might not be the best trade. An example could be, you're looking at a trade, but the floor is way above where the market's currently trading. So you think the euro dollar is going to go up. You look at that trade and you think that's great. Or maybe you think the market's going to go down and the ceiling is way below where the market's currently trading. And so the market's going to have to get all the way down there before you can even start to make money. So that may not be the best trade for you. Just because the risk is lower, you also need to look at how far does it have to move. And you really know that very simple. Where is the market priced compared to where is the spread priced? Now you may decide maybe a risk that's even higher, maybe double, right? So $5 versus $10 is more desirable because it only has to move 4 ticks to be at break even. And you might choose this because there's less movement required for you to be break even on the trade and potentially profit. And you really want to make sure you look at how far does the trade have to move so that way you put yourself in the best possible position to potentially profit on the trade. So now how do you calculate break even distance? Well, if you're going to buy the spread, you're going to take the underlying market's last price minus the spread's sell price. The reason you do that is to cover the bid-ask spread on the trade. So that's why you take the sell price on a buy order. So, for instance, if the euro dollar was last priced at 1.2010 and the spread that you're looking at, sell price, was last quoted at 1.2015, then your distance to break even is going to be 0.0005, meaning that the euro dollar is going to have to be at or above 1.2015, moving 5 pips before you're at break even. Now on the sell side, you're going to take the spread's buy price minus the underlying market's last price. Again, the reason you take the buy price when you're selling the spread to calculate break even distance is because you want to account for the bid-ask spread. So if the euro dollar is last priced at 1.2010 and the euro USD spread ask buy price was last quoted at 1.2005, then you take the last price 1.2010 minus the spread's ask price 1.2005, and you get your distance to break even, meaning the euro dollar needs to move down at least 5 ticks by expiration to be quoting the spread at 1.2005 or lower for you to be at break even or potentially profit. And though it may be obvious, I just want to point out that there's a difference between break even distance and risk reward. For your break even distance, you're looking at how far the trade has to move to be at break even. So the difference between where the spread is currently priced compared to the market plus the bid-ask spread, or the formula that we just went over. On risk, it's how much money is actually at risk on the trade. So if buying, that's the difference between where the spread is bought and the floor, or if selling, it's the difference between where the spread is sold and the ceiling. If you want to know more about risk and reward, make sure to watch the video titled Nadex Bull and Bear Box Spread Strategy Examples to see how to easily calculate risk and reward potential on an Nadex spread. So now, once you've looked at the spreads that are available, so you've chosen your category, Forex, you've chosen euro dollar, you've chosen that you want to sell the spread, and you've found the spreads that have an acceptable break-even distance. Now, out of the ones that are left, you want to look at the risk and the reward. So, first thing to look at on risk-reward is your risk-reward ratio. For every dollar you're risking, how much potential reward is there? So, a risk-reward ratio, say 1 to 0.5, means that for every dollar at risk, there's a potential to make an additional 50 cents. Probably not the trade that you're looking for, okay? A risk-reward ratio of 1 to 1 means for every $1 at risk, there's a profit potential to make an additional dollar. So $1 could make a potential additional dollar. Now, a risk-reward ratio of, say, 1 to 20 means that for every dollar at risk, there is the potential to make an additional $20. So you're really looking for a great risk-reward ratio, and that's pretty simple. I mean, if you see that it's $50 at risk and $50 reward, it's a 1 to 1. If you see it's $10 at risk and a $90 reward, then you see it's a 1 to 9 risk-reward ratio. So now let's talk about the risk per spread. You want to manage your risk, then manage your profit. Now, one of the great things is that spreads automatically manage your risk, as you can't lose more than the initial risk or margin required to place the trade. However, you must choose how much to risk per spread, so you need to analyze each spread for risk. So now you need to look at your reward potential. How much profit potential exists within the spread? And this is really important, obviously, but there's a really important tip that you can miss out on, and if you miss out on this, it could cost you a good amount of money. Is some trades will have the exact same risk. They'll have the exact same expiration time. But one of the two spreads will have more potential reward. So in this case, which one would you choose? Spread A has a $10 risk and a break-even distance of 5 ticks. It expires at 3 o'clock, and the maximum potential reward is $95. Spread B has a $10 risk, a break-even distance of 5 ticks. It expires at 3 o'clock. It has a maximum reward potential of $195. So would you choose spread A or spread B? Obviously, you would choose spread B. There's no reason to ever choose spread A when your risk is the same, your break-even distance is the same, and your expiration time is the same when you have the potential to make more money with spread B. Another easy way to help you quickly narrow down which spread that you want is to simply look at the distance to the floor and the ceiling in relation to where the spread's price is. Because if you want to buy the spread, you want a spread where the floor is close to the underlying market's price. Meaning, I want there to be as little risk as possible because I can't lose money below the floor on a spread. So I want that to be as close as possible to that floor because that limits my risk. Well, maybe I'm selling the spread. Well, then I want the spread where the ceiling is really close to the underlying market's price. Again, if I'm selling the spread, I can't lose money above the ceiling. So the closer it is to the ceiling, that can help lower my risk. All right, so the next step is you want to make a watch list. And make a watch list, add all the spreads to the watch list, say for the euro dollar. Do the calculations and remove the spreads that are not close to the floor or ceiling, remove spreads that don't qualify based on, say, risk and reward ratios, and then keep the spreads that are potential trades and compare them. Making a watch list in the Nadex platform is really easy. Just log in and click New Watch List. After you click New Watch List, enter the name of the watch list and hit Submit. And that'll actually create a new watch list for you. Now what you can do is you can go over here to the Finder section and choose Forex, then choose euro dollar, and then expand each one of the time frames so you can see each one of the spreads. Right click on it, and what you'll see is that you can add it to the watch list, and then it'll say which watch list do you want to add it to. So I want to add to the euro dollar watch list, and then just simply hit Submit. Repeat this process and add each one of the spreads to your watch list. To choose your watch list, just click Watch List over here in the top right, and then from your drop-down menu, choose your euro dollar watch list, and it'll pop up. Now that you've made your watch list, you're going to want to do your calculations to look at risk reward, break-even distance, and things of that sort. And to do the risk reward calculations is really easy. All you have to do is click on the bid side if you want to sell, or the offer side if you're wanting to buy. And what it'll do is it'll automatically pop up the ticket with the sell and the current price filled in. All you got to do is change the quantity to 1, and you'll see the numbers right there. And you could place the order if you were ready. But before you place the order, make sure that you do look at them and do your calculations to find the best spreads for you. So once you've done your calculations, let's say you came up with a list, and this is what your list looked like. Then what you'd do is you'd go in, and again, you'd look at your time to expiration here. So these expire 11 minutes, 71 minutes, 1,031 minutes from now. And you could look at the width of it, but you want to go over now, you want to look at, remember, what do you want to look at next? Break-even distance, okay? So how far does the trade have to move for you to make money? And then you want to look at your risk and your reward and your risk-reward ratio, and narrow it down and remove ones that don't qualify. You also may want to remove ones that don't qualify based on where the market's at. So the market right here is at 1.2557, and you may want to go in and remove any spreads whose floor or ceilings aren't close to the market's current price. The way you remove them from your watch list is really simple. Just click right here on the Options tab and click Remove, and you can remove each one that don't qualify. So now that you've narrowed it down to your top 3 choices, then what you're going to do is look at the several factors we discussed. So you look at expiration. This one expires in 11 minutes. These two expire in 71 minutes. So right there I'm going, you know what? I may not want the 11-minute one unless I expect the move to happen in the next 11 minutes. And then I go over and I look at break-even distance next. So on break-even distance, I have 2 ticks to break even, 8 ticks to break even, 9 ticks to break even. So really, 9 or ticks, 8 ticks, 2 ticks, not that big of a deal. The euro dollar can easily move 4, 5, 6, 7, 8, 9 ticks without even trying that hard. So I'm not really going to be that concerned. In this instance, I'm really not going to worry about break-even distance. So now I'm going to look at risk. Well, on risk, this trade is going to risk $15 per spread. This one risk 11. This one risk 10. So I'm already favoring these two because they have less risk. I'm going to go here and look at reward. This one's 81 and this one's 85. So less risk, more reward, already paying off. This one's $10. This one's $236. So I really like that number right there. Compared to all the other ones. And then we look at our risk-reward ratio. On this one, for every dollar at risk, I have the potential to make $5. For this one, for every dollar at risk, I have the potential to make $7.22. For this one, for every dollar at risk, I have the potential to make $21.87. So looking at all those factors, it becomes sort of clear. 11 minutes, 2 ticks to break even, $15.80, which is greater than all the others. A reward that really isn't greater than all the others, and the lowest risk-reward ratio out of the group. So I'm going to cross this one off the list. And now I have these two. They both expire at the exact same time. They basically have the same move to break even, and there's only really $1 difference on their risk. But the big factor here is the reward or the risk-reward ratio. So again, same time to expiration, basically the same break-even distance, basically the same risk. This one can make 236 bucks. This one can only make 85 bucks. So understanding that right there, it's clear to see that this is the best spread to choose in this instance if I'm wanting to go in and sell the euro dollar. So again, to review, the 5 steps to picking a Nadex spread are: 1, choose your market, such as Forex, euro dollar. Your direction, I want to say sell the euro dollar. Time to expiration, well, I think, over the next, hour, 2 hours, 3 hours, however long, you pick that down. Then you go down to break-even distance, how far does it have to move? And then you look at your risk, and then you look at your reward to find the best spread. If you have any questions about this, definitely feel free to hop on our website and let us know.